All right. Good morning again, everyone. This is Jason Dahl with AFS. I'm excited for today's webinar entitled Year-End Tax Planning Strategies. It's hard to believe that we are officially, in year-end territory, getting close to Thanksgiving. So today's presentation, the lead presenter today will be Alp Atabek, the founder of AFS, and I guess you could say a reformed CPA. So he's certainly well suited to give today's presentation. And before we launch into the presentation, I just want to let everybody know that we are recording today's presentation, and we will make that recording available. Usually takes a little bit for that to all to get downloaded and processed, but by next week for sure that'll be available. And then we can also send just copies of the slides too if anyone is interested. And then throughout the presentation, please feel free to ask any questions. You should see kind of in the centered bottom part of your screen a little Q&A icon, and you can click on that, and that will open a little dialog box where you can type in any questions or comments. So without further ado, I'm going to turn this over to Alp, and I believe we try to keep this to around 30-35 minutes or so. So that everybody is not late for any lunch dates. All right, there you go, Alp.
Good morning, everybody. As Jason mentioned, I am a former CPA. My first career, I basically focused entirely on preparing individual income taxes. I want to point out that this is not the beginning of a comeback for me. I have no intention of entering the tax business again. I think I said this on last year's seminar. When I look back on my life, the day I exited the tax business is possibly one of the happiest days of my life. Our title for today's presentation is Year-End Tax Planning Strategies. And I apologize in advance if my raspy fall voice from riding bikes outdoors and just getting all of the pollen and whatever other contaminants are caught in my throat. A few of the standard tax jokes. In the past, tax reform never meant simplification. However, the Tax Cuts and Jobs Act of 2018 did actually simplify things. The new tax law substantially increased the standard deduction, and as a result, approximately 28 million taxpayers took the standard deduction in 2018 that previously itemized their deductions in 2017. I have to admit, that's real simplification. It worked. For a lot of people, filing taxes was a lot easier. Our agenda for today, I will review the 2019 tax brackets, explain how the child tax credit works, review itemizing under the new tax law, go over a few tax planning strategies, and close with our main takeaways in a Q&A session. A few facts on our tax system. The U.S. has a progressive tax system, meaning people with higher taxable incomes pay higher federal income taxes. Taxpayers fall into one of 7 brackets, depending on their taxable income: 10%, 12%, 22%, all the way up to 37%. Tax rates differ for long-term capital gains, qualified dividends, etc. These lower rates are scheduled to expire in 2025, and I think a lot of people have forgotten that the tax law that was passed in 2018, lots of it is temporary. The tax brackets are basically the same as 2018, which was the first year with the new Tax Act, but they're indexed a bit to account for inflation. Let's take a look at the 2019 tax brackets. Here's how the tax brackets work. You pay tax based on your taxable income. For example, a single person with $200,000 of taxable income will have a portion of their income taxed in the first 5 tax brackets. The first $9,700 of income will be taxed at 10%. Then the amount over $9,700 up to $39,475 will be taxed at 12%, and so on. The amount of the taxable income above $160,725 up to the $200,000 of income, that will be taxed at 32%. The new tax code eliminated the marriage penalty, though through the 32% bracket, which is a big improvement compared to the rules in place in 2017. They basically double the single rates for married filing jointly through the 32% bracket. And you can see that on the chart. The marriage penalty resurfaces in the 35% tax bracket, and no penalty for those that filed married filing separately through the 32% bracket. Again, a major improvement from the old days. As you can see, the top federal bracket for 2019 is 37%, same as last year. The standard deduction has been indexed for inflation in 2019. The standard deduction is simply a deduction the government gives you for free without having to itemize your specific deduction. So basically a time saver. They averaged what they thought most people would have. If you add up your various itemized deductions and that total is greater than your standard deduction, then you deduct that total from your income instead of using the standard deduction. To refresh your memories, the standard deduction became substantially larger in 2018 with the new tax law. As an offset, you no longer get a personal exemption in addition to the standard deduction. In 2019, if you file as a single taxpayer, your standard deduction is $12,200 compared to $6,350 in 2017. If you file married filing jointly, your standard deduction is now $24,400 versus $12,700 in 2017. The chart on the screen lists the standard deduction for the various other filing statuses. Taxpayers 65 and older get a larger standard deduction. If you file as single and are 65 or older, you get an additional standard deduction of $1,650. A married couple, both age 65, will now get a $27,000 standard deduction. That's $24,400 plus an additional $2,600 for both being 65 or older. Personal exemptions have been replaced with the child tax credit for dependents 16 and under, and the family tax credit for dependents 17 and older. Remember, a credit is a dollar for dollar offset of your taxes, much more valuable than a deduction. For the child tax credit, you get a $2,000 credit for each qualifying child. If you have 3 qualifying kids, that's a $6,000 tax credit. For large families, this is a massive tax break. My wife was the youngest of 8. Today, when factoring in the standard deduction, a family with 8 kids under age 17 could earn around $110,000 and not pay any federal income taxes. 8 kids under the age of 17 would give you a $16,000 tax credit on your federal return. This is a huge tax break for taxpayers with qualifying children that are under the phase-out limits for the credits. The family tax credit gives taxpayers a $500 credit for qualifying dependents aged 17 and older. The credits phase out above certain income levels depending on your filing status, and we've got that on the screen for single people. The credit phases out between adjusted gross income of $200,000 to $240,000. For married filing joint, the credit phases out between adjusted gross income of $400,000 to $440,000. Again, credits just very valuable change to the tax law for those with families, and those with large families benefit substantially. When you hear the term itemized deductions, you think of the 4 main deductions: state and local taxes, mortgage interest expense, charitable contributions, and miscellaneous itemized deductions. I'll skip medical expenses as it's rare to exceed the filing threshold in order to be able to deduct medical expenses. One of the most controversial changes in the new tax law in 2018 was the $10,000 cap for deducting state and local taxes. This was a major change for taxpayers in high-income tax states such as Maryland, D.C., New York, California, Massachusetts, New Jersey, amongst others. Previously, the deduction was unlimited. If you're a high-income resident of a state without state taxes, such as Florida, the new tax law is a windfall for you, and that's why high earners have been moving to Florida. In our example, we show you a taxpayer that pays $12,000 in real estate taxes and $24,000 in state income taxes. In 2017, that taxpayer was able to deduct the full $36,000 paid, but in 2019, that same deduction is capped at a whopping $10,000. If you live in a state with high real estate taxes and high state income taxes, the new tax laws severely limited your tax deduction for those items. When you factor in the $10,000 SALT cap and the new limits on mortgage interest deductions, you can understand why the high-end housing market is suffering under the new tax law. As a former CPA, I struggle to understand how these changes were agreed to, especially, and I joke about this, especially when you consider that our president is a real estate developer. It just doesn't really make sense. The new law caps the amount of mortgage interest you can deduct for homes purchased after December 16th, 2017. And this is for personal residents, not business or real estate or commercial real estate. You can write the interest off on your first $750,000 of mortgage debt. The old law capped the deduction at $1 million of mortgage debt plus an extra $100,000 for a home equity line. You can borrow a larger amount for a house, but your mortgage interest deduction will be capped. It changed the deductibility for home equity lines. Home equity lines are now deductible only if they are used to buy, build, or substantially improve the taxpayer's home that secures the loan. They are subject to the same $750,000 cap. For example, if you have a $650,000 mortgage on your home, you can only deduct the interest on the first $100,000 of a qualified home equity line. They did grandfather in the old rules for homes purchased on or before December 16th, 2017, and we've got that written up here. So essentially, if you had a $1 million mortgage and a $100,000 home equity line, right now you're actually still can write off the $1 million home mortgage. For charitable contributions, no real changes here. Basically, the same rules apply. We listed the three most common types of charitable contributions: cash, check, and credit card contributions; non-cash charities such as clothing, furniture, and miscellaneous household items; non-cash charities such as gifts of appreciated securities, basically stocks. They're all still deductible as long as you itemize deductions. So again, no changes here. This was a major change last year. Miscellaneous itemized deductions, they've been eliminated for years 2018 through 2025. All of your miscellaneous itemized deductions are eliminated for these years. This affects Schedule A only, which is where you write off your SALT taxes, mortgage interest, and charitable contributions. It does not affect Schedule C for business expenses or Schedule E for rental real estate expenses. If you're an employee, not self-employed, and have unreimbursed employee business expenses, such as business mileage, travel expenses, business meals and entertainment, the new tax law eliminated those deductions. If possible, get reimbursed for those expenses. If you have a lot of unreimbursed employee business expenses, you may be better off with the lower salary if your company would then reimburse you for your out-of-pocket business expenses. For example, if you have a $100,000 salary and have $5,000 of unreimbursed out-of-pocket business expenses, you would benefit tax-wise with a $95,000 salary if your employer then reimbursed you for your $5,000 of out-of-pocket business expenses. We've also seen some employers institute plans. They have a bonus program. They will, instead of giving the full bonus, they'll reimburse the employee partially. Say if they have a $10,000 bonus and if they had $5,000 of unreimbursed business expenses, they will give them a $5,000 bonus and reimburse them $5,000 for their unreimbursed employee business expenses. Again, it's actually very favorable to do that tax-wise. As a result of these changes to itemized deductions, fewer people will itemize. The combination of the larger standard deduction, the cap on the SALT deductions, and the elimination of miscellaneous itemized deductions made it so many people that previously itemized deductions did not in 2018, and the same will happen in 2019. As a result, as we discussed earlier, this simplified tax preparation for millions of taxpayers. In our example, we have a married couple with $22,500 of deductions. In 2019, their $24,400 standard deduction is larger than their itemized deductions, so they will not itemize their deductions for the year. Under the new tax law, if your house is paid off or you have a small mortgage, there is a good chance you will not itemize unless you have a substantial amount of charitable contributions or a large amount of deductible medical expenses. The fallout. We expected this to happen, and it is. Because of the $10,000 cap on the SALT deduction, high earners are fleeing the high income tax states and moving to Florida and other states without income taxes or low state income taxes. You might be thinking, good riddance. We didn't want them around anyway, and I joke when I say that, but this is a real problem for states with high income taxes. For example, last year, a relatively small number of wealthy families left Maryland and blew a nearly $80 million hole in Montgomery County, Maryland's budget. This is happening all over the country. There have been reports of high-income hedge fund managers and owners of businesses moving their entire operations down to Florida, primarily because of the $10,000 SALT deduction cap. This is not a one-year adjustment. They are losing those tax dollars on a permanent basis, and this will become a long-term problem for the states that are losing their high-income taxpayers. Here's a tax planning strategy called bundling. Bundling deductions is the process of lumping payments you would make over multiple years into one tax year. Bundling deductions will potentially allow you to itemize your deductions in certain tax years. We are primarily seeing this used with charitable contributions, but the same concept can be used for taxpayers with a substantial amount of deductible medical expenses, though that is rare due to the threshold you have to exceed before you can itemize medical expenses. We have a great example of bundling on the next slide. This is a married couple that has $23,000 of itemized deductions, of which $10,000 are charitable contributions. Under option number 1, you see that they get the standard deduction in 2019 and 2020. That's on the left side of the screen, because their itemized deductions are less than the $24,400 standard deduction. They made one change in option number 2 on the right side. Instead of giving $10,000 of charity in each year, they gave $20,000 in 2019 and $0 in 2020. In our example, they now have $33,000 of itemized deductions in 2019, and they take the $24,400 standard deduction in 2020. This simple move of bundling their charitable contributions allowed them to increase their deductions by $8,600 over the 2 years, which results in substantial tax savings. Another tax planning strategy to consider is to donate appreciated securities instead of cash. Let's say you own 100 shares of XYZ company stock worth $10,000 with a tax basis of $2,500, and you normally make a $10,000 charitable contribution to your alumni association each year. Instead of sending them a check, consider donating your 100 shares of XYZ company to your charity. You still get a $10,000 deduction on your taxes as long as you itemize, but you never had to pay tax on the appreciation of your shares. Most charities are aware of this tax strategy and have the processes in place to receive gifts of appreciated securities. One thing to keep in mind, the shares you donate have to be held for over 1 year. Also, if you want to continue to hold XYZ company, you can buy 100 new shares of the company and establish a new higher cost basis for the shares, a real favorable tax strategy. Another tax planning strategy to consider is the use of a donor advised fund. Think of the Bill and Melinda Gates Foundation. The Gates donated their zero cost basis shares of Microsoft to their own foundation and received a tax deduction for the fair market value of their shares on the day of the donation. Today, through the use of a donor advised fund, many people are setting up what is basically their own personal foundation to help facilitate their charitable endeavors. Very easy to set up. You donate appreciated securities or cash to the donor advised fund and claim a tax deduction for the year you make the donation to the donor advised fund. This is a great vehicle to consider if you are bundling your charitable contributions or if you're trying to reduce your tax burden in a high tax year. For example, we have had clients donate appreciated securities to their donor advised fund the year or two before they retire to take advantage of the deduction while they are still in a high tax bracket. So they will actually make 4 or 5 years of normal donations into their donor advised fund. It makes a lot of tax sense to do it, and then they can disperse it from their donor advised fund at their leisure over the next 4 or 5 years. Here's a summary of some of the advantages of using a donor advised fund. Planned gifts can be made in the tax year when they are most advantageous. Grants to charity can be made at the donor's convenience and discretion. Administration and record keeping are all handled by the donor advised fund. If you actually try to set up your own personal foundation and not do it through a donor advised fund, you're actually responsible for the tax filing. So this is just a great way to donate appreciated assets. Very simple, straightforward. We've probably set up about 20 of these over the last couple of years. Very, very easy to do and just really just some great tax benefits. A tax planning strategy to consider if you're taking RMDs, required minimum distributions, from your retirement accounts. You can essentially donate all or a portion of your RMD directly to a charity. Your donated RMD is not considered taxable income to you, and you do not get to claim a charitable contribution for the donation. This is a great tax strategy to consider if you give to charity and you do not itemize deductions. If you do this, you need to remember to tell your accountant or yourself, if you're doing your tax yourself, that you implemented this strategy, because your 1099-R for your RMD for the year will reflect the full amount of the RMD, even if you sent all or a portion of it directly to charity. But you get to exclude from your income the amount you sent directly to a charity. So if your 1099-R for your RMD was $25,000 and you donated $10,000 of it directly to a charity, you only have to report $15,000 of income on your taxes for that year. HSA accounts are gaining in popularity in recent years. They are accounts that can be used to pay medical expenses. You need to be enrolled in an HSA eligible health insurance plan in order to fund the account. An HSA eligible health plan is a high deductible health insurance plan. Not everyone has HSA eligible health plans available to them, But if you do, and you are not a high user of medical services, it might make sense for you to explore the benefits of an HSA account. HSA accounts are similar to flexible spending accounts, FSA accounts, in that the accounts are used to pay medical expenses. But the big difference is you have to spend all the money in an FSA account each year, or you forfeit the balance. You do not have to spend the money in your HSA account each year and can accumulate the money to help pay your medical expenses in your retirement years. Your contributions into HSA accounts are tax deductible, and the qualified distributions from the account are tax-free. For 2019, for single coverage HSA eligible health plans, you can contribute up to $3,500 into an HSA account. For family coverage HSA eligible health plans, the contribution limit is $7,000. Many companies now allow you to fund HSA accounts through payroll deductions, which makes it a lot easier to fund. So this is tax planning strategies for the next generation. Today, most employers offer traditional 401ks and Roth 401ks. The difference is easy to understand. You contribute money into a traditional 401k on a pre-tax basis, while contributions into a Roth 401k are made on an after-tax basis. And this is basically a relatively, I'll say, last 5 or 6 years plan that's basically gaining in popularity a lot over the last couple of years. But here's the key difference. Distributions from traditional 401ks are taxable to you, while distributions from a Roth 401k are tax-free. And if you roll your Roth 401k into a Roth IRA, another difference is you do not have to take required minimum distributions from a Roth IRA when you turn 70 and a half. A big advantage if you don't need the money for retirement. We are big believers that the younger workforce should be funding the Roth 401k early in their careers while they're in low tax brackets. We highly recommend funding Roth IRAs for those that are eligible in addition to funding a Roth 401k. The Roth IRA is similar to the Roth 401k, no deduction for the contribution, but the money will grow tax-free for life. And as I mentioned earlier, no forced RMDs. Lastly, we recommend funding HSA accounts for those that are eligible, especially for individuals early in their careers while they are generally low users of medical services. And if you can afford it, consider gifting money to your kids to help them fund their Roth 401ks, Roth IRAs, and HSA accounts. Really just a great long-term family tax planning strategy. A Roth conversion is when you transfer money from a traditional IRA to a Roth IRA. It's a fully taxable event if you do not have a tax basis in your IRA accounts. You don't have to convert your entire balance. You pick how much to convert. We generally recommend partial Roth conversions for seniors and others when the tax timing is right, and it's not right for everybody. I'll go through a few examples of when it might make sense to consider a Roth conversion. If you have excess itemized deductions, and we've seen this a lot if somebody's in assisted living. My father, for example, in the last 3 or 4 years of his life was actually in assisted living, and they had my mom and dad had substantial medical expenses where they actually had negative taxable income. So in that scenario, we could convert money from my dad's IRA into a Roth IRA without any tax consequences at all. So for example, if they had a $50,000 negative taxable income, we could actually convert $50,000 of his IRA to a Roth IRA, or my mom's IRA to a Roth IRA, and that would have been a completely tax-free move. Some people also go a little further, and they'll actually convert enough to basically take advantage of the really low tax brackets, the 10 and 12% tax brackets. It also might make sense if you're in a low tax bracket and your beneficiaries someday are going to be in a high tax bracket. So if you think you're going to have a lot of extra money in your IRA account that will go to your beneficiaries, and they're in substantially higher tax brackets than you, it might make sense to convert a little bit each year and take advantage of the lower brackets. Also, if you're living in a state without state income taxes, such as Florida, and your beneficiaries live in a state with state income taxes, it might make sense to consider doing a partial Roth conversion, because when the next generation inherits your retirement account, they're actually going to inherit it and pay taxes both on the federal and state level if they're a resident of a state with an income tax when they inherit the money. One thing to keep in mind, if you do a substantial Roth conversion, it may impact your Medicare premiums. But overall, this has just been a great strategy when it's just the proper time to do it, when somebody generally has a lot of excess tax write-offs. A few tax planning strategies to consider for those that will itemize their deductions in 2019. Prepay your January mortgage payments by December 20th, and I just arbitrarily pick that number. That's generally when I do it, because then you're confident that the payment will be credited in 2019. If you wait too late in the year, sometimes it'll actually be credited for the next year, and it's really not worth making a note on your account, on your tax return that says you actually paid it early. Donate appreciated securities instead of cash. And for a little year-end house cleaning, donate clothing and other miscellaneous household items before the new year. Our main takeaways: the larger standard deduction combined with the SALT limitations will result in fewer people itemizing. Consider bundling deductions if you will benefit from the strategy. Consider donating appreciated securities or using a donor advised fund. If eligible, consider funding an HSA account and start them early. Help the next generation with its tax planning. Think about the Roth 401ks, the Roth IRAs, and HSA accounts.
All right, excellent. Well, thank you, Alp. We're just confirming here that we've addressed any questions. I think we did have one question come in. I think Alp has it in front of him here. We're going to address that now.
This is actually a standard question from my old tax days. It's about deferring income into the next year. And this usually happens when somebody's self-employed and they've had a really good year and they want to try to defer some of their income into the next year. Really, the only thing you consider is you want to make sure that you're actually not confirming it or not deferring it into a higher tax year. So for example, if you've got a higher tax bracket in 2020, you don't want to defer income into that. So pretty straightforward to think it through. If you have any questions, let us know. You can email us or call us, Jason or myself. We're happy to help you with any of these tax questions, though I'll throw out that caveat. I consider myself a rusty CPA. It's been a long time since I've actually prepared a lot of tax returns.
Excellent. Yeah, so like I mentioned before, we are going to have the recording of today's presentation available probably early next week. We can also send just copies of the slides if anyone would like that. And we will be sending out a note with a link to that recording and the slides. So again, thank you everyone for joining us today. I think we're kept it right on time. Well done, Alp. Yeah, again, please don't hesitate to reach out. Let us know if you have any additional questions. Take care.
Happy holidays.